All right, y'all. So, welcome to Passive Income University's Options Mechanics Part 2, Tools for the Trade. So, I do have a Part 1 that is available if you are a member of the Passive Income University community. So, you can see Part 1 at any time if you sign up. But this is Part 2, Tools for the Trade. So, definitely going to be leaning on the chat if the audio starts to sound funny because it is a bit distracting on my end. I got another device over here, so I can keep my eyes on the chat. Y'all just let me know, and then I could just do away with that and use my main computer. But let's go ahead and get started with the disclosure slash disclaimer. All right, so like the legal notice. Let me go ahead and throw us up here. All right, so this information presented in this options trading course is for educational purposes only and is not intended to provide investment or trading advice. The course is designed to provide general information on options trading and should not be considered as personalized investment advice or a recommendation to buy or sell any securities. The course content is based on the experience and opinions of the instructors, and we do not guarantee the accuracy or completeness of the information presented. Options trading involves significant risk, and it is possible to lose money. Any trading decisions you make are solely your responsibility, and you should always conduct your own research and analysis before making any investment or trading decisions. We do not guarantee any specific trading results or profits, and past performance is not indicative of future results. Trading options involves complex financial instruments, and it is important to understand the risk involved before making any trading decisions. We are not registered investment advisors or broker dealers, and we do not provide any investment advice or recommend any securities. We strongly recommend that you consult with a licensed financial advisor or broker dealer before making any investment or trading decisions. By accessing this options trading course, you agree to the above disclaimer and understand that the information provided is for educational purposes only. You also agree to hold harmless the course instructors and their affiliates, partners, and employees from any claims, losses, or damages that may arise from your use of the information presented in the course. All right, now that we got that going, let's go ahead and jump into it. Okay, so about my trading career and journey. So I took my first options trade in June of 2020. Just to give y'all a quick recap of how it came about for myself is I'm actually just going to go ahead and uh leave it in this right here that way because it is just very distracting for me. All right. So in June of 2020, during the pandemic, as we all know, a lot of us got exposed to trading, whether it was options, crypto, forex, commodities, or whatever the case may be. And I'm working from home basically. And as I'm working from home, I'm realizing like I'm getting super lazy, getting out of shape. I'm eating whatever, doing whatever. So my higher self, call it God or the universe or whatever the case may be, told me that I needed to get out and go get some exercise. Now I'm out here in Southern California. I'm in San Diego, and there are a few areas where are most of the city are goes to exercise in public places, right? And very popular. And so one of those places is known as Seaport Village, which connects to our convention center. And so I went out there just to get a few steps in, just to get some cardio in and walk. And when I'm out there, I noticed this was during the pandemic. This might have been April of 2020. I noticed that everybody that was out there was already like fit and in shape. And something told me, as we all had different perceptions of how the pandemic was going to go, something told me that the people who really hone in and double down on whatever they want to focus on are going to be exponentially leaps and bounds ahead of where they started from. So, what I landed on was I wanted to get my finances in order. I wanted to get my finances straight. And so something told me to start looking in stock investing. That's where I started. And of course, when you're excited about something, you usually tell people that are the closest to you. So I hit my homeboy up, told him that I was going to start looking at, trading stocks and investing in stocks. And he said that's a trip because he had just joined an options trading community. It was a group of people that were beginner traders and they just wanted to share their experience, what they were doing, their trades, and all that. So I joined the community, and that's what exposed me to options trading. Now, I took my first options trade in June of 2020. It was on Carnival. And I don't know if you guys remember when all of the cruise lines were in jeopardy of going bankrupt and going out of business. And anytime there was some bit of good news for a cruise line, their stock shot straight up. And so that's what happened with Carnival. I got some Carnival calls, and they had got news that they were going to get some type of bailout or some funds to help them. And the stock shot up. I remember making like $50 in a matter of like 30 minutes. And that's what really got me started. But I never, let me go back. I never really took trading super seriously. It was just something that was very spotty for me. And so between 2020 and 2022, I lost thousands of dollars, made plenty of mistakes, headaches, heartbreak, stress, almost to the point of tears, things like that. And then in January of 2023, I made it my business, or I became committed to options trading, like really, really taking it seriously, really, really identifying where my mistakes were, how do I become consistent, things of that nature. And then, of course, in 2024, I decided to share my experience and create a community for new traders to avoid the mistakes I made and get to profitability sooner. So, a lot of what I'm sharing are just really based off of the big mistakes that I made. That way you can eliminate all of that and get more so to the consistency and the profitability without having going through the learning curve that I went through. All right, so purpose and mission, basically, as I just said, is to give insights from my direct experience to help you become a better, successful options trader. So the structure of how this is going to go is pretty easy. It's simple and straightforward. They're going to be easy tools that you can use. And I'm going to add my reasoning and rationale as to why I think they are important. Let me kind of move this down right here. All right, good. So what we're going to cover, got to do some shifting all over the place. So what we're going to cover is creating a watch list, creating a trading journal, making a backtest log, developing a risk management strategy, some daily indicators that I use and that you could use, and then 3 trading strategies that I use. I'll just peep over to the chat, make sure I got that going on. Let's see. Let's see. Oh, thank you, Francisco. Big shout out to you. All right, so let's talk about creating a watch list. Now, the purpose of a watch list is to have a set of go-to stocks that you can trade. Now, you can think about watch lists like song playlists, right? It has the tracks that you know 9 times out of 10 are going to get the party started. Instead of having to search for a song, or in this case, a stock that's popular in the moment, right? Looking for the next GME or the next meme coin or the next meme stock. When you have that set playlist or watch list, you know you can go to these as go-tos that help get you going. So think about it when you're like at a cookout or a barbecue or something like that, family reunion. What are the key songs that people always play, right? There's Montel Jordan, This Is How We Do It. Mark Morrison, Return to the Mac. Tupac, I Get Around. The Wobble, the Cha Cha Slide, right? Anytime those songs come on, usually family members, cousins, aunts, and uncles, they all get up. They either start singing the lyrics, they either start doing the dances, or whatever the case may be. So, how do we determine or how do we create a watch list? Now, there are 4 components that I really look for, or that I've added, or that I basically use as a filter to see if a stock is going to get added to my watch list. First, the stock in and of itself has to have high volume, right? High amounts of volume. So we know the easy ones like Apple, Microsoft, SPY, things like that, QQQ. There also has to be high contract activity. So the options contract activity needs to be in the high hundreds or thousands range. And what I mean by that is we're going to talk about open interest and volume. And then there has to be a high amount of data. There needs to be lots of data that can be tracked to go back and analyze to compare to. So a lot of times when I'm on TikTok live with the audience and the TikTok community, people are asking about some of these coins or some of these ticker symbols or some of these penny stocks that don't have a lot of data. They probably IPO'd a few years ago. They had a huge spike and then they've been in a lull. They've been under $1 or under $5 for the last 3, 4, 5 years. And then all of a sudden now they're having a spike. It's really hard to chart those and do technical analysis on those because there's not much data. There's not a lot to pull from. It's hard to spot levels and things of that nature. If you've seen any of my TikTok lives where people ask about those, you see it's a bit challenging to chart those. And then they have to have low spread pricing. So the spread, basically the bid and the ask pricing, needs to be narrow, typically less than $10. So I want to get into taking a look at all of these components that I just described, right? Our high volume, high contract activity, high amount of data, and low spread pricing. So let me go ahead and bring up TradingView, and we can take a look at what some of that looks like. So first, we're going to start off the stock in and of itself with some high volume. Once this loads up, I'm going to close out of a few of these. We're going to keep it super simple. Let's close out of we probably should have kept that open, but we'll keep SPY, Amazon. We'll close Goog. Let's come down here. And once this loads up, hopefully, eventually, of course, it always gets a little spotty when I'm trying to bring up the trading view, but we'll get in there. Now, I'm going to just break this down. This is Starbucks. I'm going to break this down just to a single chart. And if you were on my TikTok live, I'll reiterate, I was in a Starbucks trade the other day, but because Starbucks was moving so slowly, I got really impatient and restless, and that caused me to take a trade that I didn't need to take. All right, so now I want to show y'all, let's go over to the daily volume. And on TradingView, right, you can see two areas for the daily volume right down here. It gives you just a visual display. And then over to the left-hand side, it lets you know the average daily volume versus what was it for that last day or the particular candlestick. So over here to the bottom right, you see that Starbucks had roughly 7.1 million shares that were traded, right? And so that's a decent amount of volume. But when we come over to SPY, let's make sure we go to that daily chart. You can see over here at the bottom right, SPY had 40 million shares traded in that day. So there's much, much more volume there. And the reason why the volume is important is because we know that that means liquidity. And basically, just to keep it super simple, liquidity translates to your ability to get in and out of a trade. If there's lots of volume, that means you know you have a high level of confidence of being able to get in and out of that trade. If there's low volume, then you may have some issues getting in and out, especially out. Now, that's going to translate to the other components that I just described, right? So let's go back over here. High contract activity. The options contract activity needs to be in the high hundreds / the thousands range. And so I have a couple of examples that we want to take a look at. We're going to compare Apple versus Eli Lilly, or ticker symbol LLY. So let's go back down here. And I wanted to show y'all. All right, here's Apple. And we want to take a look at trading some Apple options. Now, this is known as the options chain. So when you see all the different available options, kind of strike prices that you can choose from on any platform, this is what people are referring to when they say the options chain. So if we go here and we're taking a look at Apple, we'll say $210 calls. The key that I'm looking for to add any particular ticker symbol to my watch list, my daily watch list, is high volume and high open interest. So right here, we see with Apple, this particular strike price, $210, or basically particular contract, has 11,233 contracts that were traded on the previous given day. So in this case, we're referring to yesterday or Friday. And then open interest means how many contracts are still outstanding or waiting to be kind of exercised or traded. So think about this as being like a concert, right? You want to go to a concert where it's popping, or maybe a club, because you know if everybody's over there, there's a higher chance that you can get some of the action, some of the profits, things like that. But if we compare that to, let's say, Eli Lilly, for example, we'll tag that in right quick. And this doesn't mean that you can't do these types of trades. We just want to build a watch list where we know we have some go-to. As you get more specialized and your skill set increases, you can definitely add some of these ticker symbols that are lower volume, but I definitely wouldn't recommend it for us beginners out there. So if we take a look at options for Eli Lilly, we'll come down to where it's at in the money. And of course, you guys let me know if you have any questions. Periodically, I'm going to check in the chat, but feel free to come off mute or whatever the case may be. Don't hesitate. Any question that you have is not a bad question. Rather, no matter how simple you may think it is, or how intricate or how big, I am here for y'all. So right here, as we look at these Eli Lilly calls, the volume, meaning the number of contracts that were traded on the previous trading day, Friday, was only 562, and the open interest is only 1,035. And so that's still okay, but there's not a lot of liquidity in there. So you might get caught up looking for a buyer when it's your time to sell. You might get caught up a little bit of a delay when Robinhood or Webull or E-Trade or Thinkorswim goes out to look for a buyer to buy your contracts when you want to sell and profit. Now, part of what that connects to or translates to is what's known as the spread, or the bid and the ask. So if we go back to what I was talking about here, low spread pricing. So we're still going to continue to compare Apple to Eli Lilly right now, right? So let's go back and I want to show you exactly what I'm talking about in terms of why I would add Apple and not add Eli Lilly to my daily watch list. So if we went ahead and let's say we wanted to add this contract to buy for Eli Lilly. Now, here is what it looks like. What we have is this bid and this ask. Now, as a buyer, what we would be looking to have to pay is the asking price, right? So here it says 1085, but we know with options contracts, we know we have to multiply by 100. So really, this would be $1,085 to buy one contract. And then the bid is what the seller gets, right? So this is what creates the spread. This is what makes the spread. This is what the brokers have to do to be able to provide some liquidity or movement or basically functionality with these contracts. But what we can see here is that the spread is $65. Now, why is that important? And what does that mean? And why am I putting emphasis on it? So if you got into this Eli Lilly trade right away, you would pay $1,085. But let's say right in that moment, you say, you know what, I don't want to be in this trade. I made a mistake, or instantaneously you realize something happened that makes you want to exit. Maybe some news came out right when you got in the trade, or maybe you realize you did your charting wrong, or whatever the case may be. With no movement, no change in the stock price, you would lose $65 just trying to get out of this trade with Eli Lilly. Just trying to get out of it, you would lose $65. And that's the spread there. That's basically the broker saying, okay, in order to get you out right now, we do have some buyers that are willing to buy it from you, or at least buy it from us to get your profits or your sale to you for $65 less or $1,020. And me personally, I don't like the spreads to be too wide. I don't want to be in a position where I'm going to easily lose money if I want to exit the trade quickly. And this also connects to as the price moves up, or if the trade is moving in your favor, whether you have calls or puts, you have to account for that large spread. When you're in a trade and you're like, okay, I see some profits. Let me go ahead and try to take my profits. What the platforms do is they show you what the high price is. They show you what, like, basically the asking prices, but that isn't necessarily what you'll be able to sell your contracts for. The real sell is going to be that 1,020. So this is why, just to kind of protect myself, I don't want to add ticker symbols that typically have wide spreads to my watch list. So y'all let me know if that makes sense, if I'm connecting there, if that makes sense in your mind. What we'll do is we'll compare it to Apple really quickly. Let's go to AAPL and let's just look at a quick difference, right? So we saw on the Eli Lilly that it was a $65 spread. But if we go here and we look at these Apple options, let's go ahead and click that. We're bringing it back down to where at the money is at. What were we looking at? 210. And if we add this, all right. So even with these Apple contracts, it does show a wide spread of $25. Not as bad as the Eli Lilly. And this is reminding me to let you know that when the market is closed versus when it's open, the spreads may fluctuate just a little bit, just a little bit. But maybe this is a little bit too risky for you. You know, based off of my own criterion, I wouldn't even trade these contracts because the spread is still too wide for me. I don't want to risk losing $25 if I want to exit the trade immediately. So at this moment in time, even if my setup presented itself, even if Apple was on my watch list, it is on my watch list, I would opt not to take these until the spread shrank down to at least $10 or less. So one of the number one places where we can see that is SPY. This one I know is a guaranteed because there's so much liquidity when it comes to SPY, and we'll be able to see it. Give me just a moment. Let's let this load up. All right. Okay, now let's go down here. And it may be still a little funky because the market is closed, but let's take a look at the 543. As we can see, look at the volume here. 98,000, almost 100,000 contracts were traded. And then there's still about 3,800 outstanding ones. So we know there's a lot of liquidity. And you can almost get an idea of that bid and ask right here. But let's go ahead and add it as a potential one that we want to buy, right? So as we see right here, look at the difference in the spread. It's only $1, only $1. So if I got into this options trade with these particular SPY calls, and let's just say with no change in the price, there was no movement, I realized I made a mistake and I want to get out of the trade, I'm only going to lose $1, right? You're buying at 96, but you can sell at 95. That is what I like to see. I like to see the spreads that are $10 and less, because that lets me know that with no changes to the movement in price, I'm very, very limited as to how much I'm going to lose. And it works on the profit side too. So as the profit starts to move up, you won't have to worry about a big chunk of your profits being ripped away from you because that spread is so wide. So just to reiterate, in terms of adding a ticker symbol to my watch list, I like to see spreads that are $10 or less. That's what I'm comfortable with. Of course, you'll work out a strategy that fits your risk management and your tolerance, but I'm just giving you a guideline of what I use. Now let's double back. And then I said there needs to be a high amount of data to go back and analyze and compare. Like I said, when I'm on TikTok live and y'all see the comments coming through and people are asking, like, check out this ticker symbol or check out that ticker symbol, they get challenging to chart because there isn't a lot of data to analyze, right? There isn't a lot of data to compare it to, as opposed to some of these ticker symbols that are on the go to watch list like we have here, right? Apple, Amazon, Baba, Google. We can go back years and years and years and analyze plenty of the data. There's plenty of market data to analyze, to chart levels, to see gaps, to see what does it typically do during the summer, how does it perform during the beginning of the year, how does it perform at certain times, things of that nature. So if there's a ticker symbol that I'm thinking about adding to my watch list, if it doesn't have years and years of data that I can pull from, that I can back test, then it's not going to get added to my daily watch list. Now, I might still trade it, but in terms of what I check every single day, like these ticker symbols, it's not going to make it there. And so remember, the way we're playing this is just like a song playlist. What are the guaranteed songs or ticker symbols that are going to get the party started? That's going to get people moving. That's going to get you a trade. That's going to get you some profits. All right. Now, if that makes sense, y'all just let me know. If there's any questions, please don't hesitate to come off mute. And so here's just a quick screenshot of the ones that are on my daily trader. You can use these. You can take a screenshot of this. You can make a note. Of course, there's Apple. I trade Amazon all the time. Bank of America, Disney. All of these ticker symbols have some relatively good pricing. Let's see. We got something in the chat. Francisco says, makes sense. I appreciate that, bro. Thank you. Thank you. All right. So creating a trading journal. So here are the benefits, and then we're going to get into some mechanisms. And of course, if you were on the live, you saw that I kind of touched on this. But as we all know, right, it's pretty easy to understand that having a creating journal helps you identify your strengths and weaknesses, helps you recognize what trades you shouldn't have entered, and then it pinpoints ways you can sharpen your skills. All right. And so there are essentially two types of trading journals. We've got physical trading journals and we've got the digital or electronic trading journals. Now, the good thing about the physical ones is the exercise in the act of writing out your trades and lessons from trading helps you remember and internalize them much more so that they can stick with you. There's a popular quote by Erica Badu where she says, get a pen and paper, write it out, physically write it out, and watch how it manifests, watch how it comes to life. And that's very true. And there's actually data and research that shows the act of writing something out will allow it to really stick with you. You really learn it, you really internalize it. All right, Francisco says, do you ever use Think or Swim? I do. From time to time, I do use Think or Swim. I think I might have a couple of screenshots if I scroll back into the Discord, but I do have it. So the three trading platforms that I do have are Robinhood, which you guys all know and see that I use primarily. There's Webull, which I really am kind of liking. The thing that I don't like about Webull is just the mobile isn't as user friendly, like easy. And I'll give you the example that really comes to my mind when it comes to Webull. Webull, once you enter a trade, you got to go through like 3 or 4 taps to get back to see how that trade is doing. Whereas on Robinhood, once you enter a trade, it takes you right to how it's performing right then and there. And then with Thinkorswim, it's like right in the middle, at least from my experience. You enter a trade, and then it takes you back to your daily P&Ls, all your open positions, and things like that. Now, I have been hearing ever since Thinkorswim went from, what was it, TD Ameritrade to Charles Schwab, there's been a lot of problems, a lot of complaints over these last few months. But I do use Thinkorswim, and I use all three of these mainly because people in my community have Webull and Thinkorswim. So I want to make sure that I'm at least baseline knowledgeable about how it's used. But kind of touching back on Webull, while the mobile device isn't good, I do like the desktop app, and as y'all can see, it's right down here. There we go. If it'll kind of pull it up, there's the desktop app right there. So I do like the desktop app. You can set up hotkeys. I think you can do the same thing on Thinkorswim, of course, but Webull has the hotkeys that'll automatically take your default settings for how you want to do a trade, trailing stop loss, profit targets, and it'll automatically apply it to all of your trades. For sure, no problem. All right, so then we've got the digital slash electronic trading journals. And this can be in Excel, which is what I highly advocate for, or you can use an actual company that specializes in it, like TradeZella or etc. There are a bunch of them out there. Now, the benefits of having a digital or electronic trading journal allows for easy data analysis and visualization, or it can organize and filter the data by any factors you believe are important. So you can easily see what are your best and worst trading days, what are your best and worst ticker symbols, what are your best and worst trading times. That's something that's really, really cool. So let's kind of get into creating a trading journal really, really quick. And so this is really why I wanted to go on to Zoom as opposed to TikTok to really get into this. So here is my, let me bring this over a little bit. Here is my June trading journal so far. And the cool thing is, it's pretty simple to set up some of these formulas and some of these parameters. I also have a template that I put for the community so they can just download the template and use it as well. But as I mentioned, so we got the entry date, the exit date, the symbol that was traded, the type, what type of trading style was I going for? Was it a swing trade or a scalp? What was the signal time if I was relying on one? Did I follow one of my predefined setups? What was the pattern type? What were the overall notes? These are like the most important things, like right here. The notes, lesson, or rationale, my emotional intelligence, improvement opportunities, areas of success, and then the actual numbers related to the trade. Now, this is really cool because if I wanted to, I could just focus on dropping this filter down, only selecting like maybe the negatives or the losses, or over here, just focusing on my emotional intelligence, things like that. And so one thing I'd recommend if you are going to build out your trading journal similar to this is on your emotional intelligence, kind of keep it to 1 or 2 words in terms of being able to filter in the future. So if you want to go back and look at all the trades where you were just peaceful and patient and recognize, okay, if there's a pattern there, there's some commonality, try that. Of course, there's different ways you can filter down just to look for keywords in Excel, but that's something I would recommend. But I also have some of the things here. So let's look at this loss that I had on the 14th. Don't go against your intuition. I had a feeling it was going to run against me, but on how I was viewing the daily candlestick structure at my time of entry, it had formed a higher low and seemed like it wanted to push higher to the previous day high, and that was against my puts. So I was kind of seeing that, but it did present my setup. And so one of the key things that this is a reminder for me is don't go against your intuition. And then I have some other things over here, some formulas that kind of give me some data, right? My average trade size based off of the things over here. What is my average trade performance? So based off of all of the trades that I've taken so far in June, I can expect to make about $40. My average win versus my average loss. And we're over here on the bottom left-hand side, things of that nature. So now you heard me say this last night if you're on the live. If you are the type of person who jumps right in, who gets their money's worth, who uses all the features and things of that nature, then for sure sign up for TradeZella. It is a bit pricey. But if you're the type of person that's like me, where you start to use more and more features over time, I would say start off with an Excel journal, start off with an Excel or at least a physical one first. And then when you start to get that stage where you feel like, man, I need more information, I need more data, I need more analysis, then look to sign up for something like TradeZella. Right. Okay, now let's talk about making a back testing log. So this is a simple yet very manual way of seeing what the probability of your setup is. So what we want to do is we want to use Excel or Google Sheets. Each column is going to represent a factor or component of your setup. You want to make sure that you have clear and consistent definitions of what your components are. So for example, we're going to look right now and again later in the training, Curtis G's bullish engulfing. That's one of the strategies I'm going to share with y'all. And then you're going to use ones and zeros as your yeses and nos. And you're going to add the formula that updates as the filters are applied. So if you want to look for a particular scenario, when you update your filters, the formula is going to tell you the probability of that trade based off of your criterion, right? Based off of all your components. The formula is going to tell you what is the probability out of 100% that the trade is going to be successful. And then depending on how often the setup presents itself, I would aim for either at least 1 year of backtesting data or 100 to 200 instances. And the reason why that is you'll know with a high level of confidence, okay, I've gone over a full year or I've gone over 1 to 200 times that my setup has presented itself. And if you have that amount of data, you know that it's had to present itself in all these different market conditions. Was it in a condition where the market was mainly bearish? Was it in a condition where the market was mainly bullish? Was it in a condition where it was the summertime? Was it the start of the year? Was it an election year like how we're in now? So I'm going to go over it. I'm going to keep it pretty simple and straightforward and use the one that I already have built for myself. And we will take a look. And of course, any questions, y'all don't hesitate. Drop those in the chat. Let me go to open recent. And I'm kind of going to touch on this twice because it does incorporate with one of the strategies I'm going to share with y'all. But we're going to show you, or I'm going to show you my strategy right here, backtesting log. And like I said, there are other more efficient ways to do some backtesting. Let me pop over here and show you, like in trading view, you can do a strategy tester and put your strategy in if you know a little bit about how they do their scripting and things like that, and it'll automatically go back and test it for you. But I highly recommend us beginners out there starting with the Excel and doing it manually, because it's going to force the repetition is going to force your mind to make sense and get used to it. So much to the point, once you get to your 100 or 200 instances, which we can see right here, if you look over on the left-hand side of this current Excel sheet, let me bring this down so it's not so distracting. I even have some hidden, but I've gotten over 100, almost 200 instances. So what I want to show you is I'm going to go ahead and clear all the filters right quick so we can see everything. Now, I have a few different strategies down here, and this particular one is my all bullish engulfing. Now, if you remember, you guys know that I like to trade on that 30-minute time frame. So for me, this is based off of a 30-minute chart. But starting off from the top, I just want to show y'all some of the criterion that I was looking for. So kind of keep an open mind now and think about, as you develop a strategy, or even if you want to refine or change my strategy, think about some of the questions that you might want to ask yourself. And if you have any questions about the questions that you might want to ask, go ahead and come off mute off the mic or drop a comment or a question in the chat. But here we go. So of course, one of the things I wanted to record were the date that the setup presented itself, its actual signal time. So if you think about my trading journal, where I have that column for signal time, this also gives me some data possibly on how often or when does this setup really occur the most successfully. What was the symbol? All of these ones that are blank down here is because I tested it all on SPY, and then I was finally getting to the point where I was testing it out on a different symbol. And then one of the components for this particular strategy, and give me just a moment because I'm going to say it straight out so it just makes sense. But one of the components for the strategy was, were there any bearish lead up candles, right? And what I mean by that were there back to back? Was there more than one red lead up candle that presented itself on this strategy before the setup showed, before my signal? Let me go back here. And then I look for, was it above or below the previous day high? Was it above or below the previous day 50%? Was it above or below the previous day low? And then the next thing that I also analyzed with this particular setup was, what was the amount that the entry candle, the candle that I got in on, I should say entry here instead of next, what was the amount that it pulled back? And what this did was it helped me understand, that 9 times out of 10, the next candle or the candle that you enter on is going to have some pullback. So don't feel like you got to get in right away when the candle opens. Or if you do get in right away, be prepared for a little bit of a pullback. So that means seeing your options contract values dip down negative a little bit. And so I took the amount that each time it was a successful setup, how much did the candle pull back on? And then I have a formula down here that told me, or tells me, the average amounts, right? So currently, now let me tell you the strategy, this one right here. And this is one that you can use. I'm going to get to it later, so we'll probably reiterate this information. All right, so this strategy, this all bullish engulfing, this is based off of the 30-minute chart. And essentially what I'm looking for is when a green bullish engulfing candle presents itself, what is the probability that the very next candle, or the candle that I'm going to enter in on, what is the probability that it's going to be green? Meaning that if I took some call contracts, what are the chances that that is just going to be successful in that very next candle right there? As I said before, I'm a scalper. Most of my trades are pretty quickly. Now, just based off of all the instances that I have logged here, I've got over it. I went back and I manually did this. There was no automation. I went back and manually went through almost 200 instances where I saw a green bullish engulfing candle that basically ate up the red one that was right before it. And straight up and down on the 30-minute chart, there is a 60% chance that the candle that I enter in on is going to be green. Now, let me make a note. For me, I have a criterion. I have a minimum threshold of 70%. If my backtesting log does not tell me that the minimum probability is at least 70%, then I won't enter the trade. And the reason for that is think about it like this. Out of 10 times, right? Out of 10 times, that means 7 out of 10 times I can expect there to be some success. And 3 out of 10 times, then it's probably going to fail. And I just like that because it's a little bit more comforting, or it gives me more confidence. 6 out of 10, you really have a little bit of more strong mental fortitude to know you could go 4 trades back to back of the setup not working before you see one that is successful. And that's one of the hard things too, psychology wise, right? Understanding that you might be just in an area or a pocket probability wise where you got to get through those 3 or 4 bad trades. So that's part of the reason why I want it to be 70% or more, because I know, okay, I might be just in that little pocket of one, 2 or 3 trades. Once I get past that, I can get to my winning trades, right? Trading is a game of probability. Let me double check, make sure I'm not missing any questions or chats from us. For sure, for sure. So what I do, and if you guys need clarification, don't hesitate to hit me up. Like I said, this template is available in our community. So what I do is I make these ones and zeros, one meaning yes and zero meaning no. So I make it ones and zeros because it makes the formula very easy to give me a percentage or a probability. Now, what I've realized by back testing and doing all this, I realized that I'm just going to jump straight to the answer. If there are no bearish lead up candles, so we'll take that there. Remember, it was just at 60% and it jumped up to 64 a little bit. If there are no bearish lead up candles, meaning there's only one red one before we see our green bullish engulfing. And let me bring up the exact scenario or sample there so that way we know what we're talking about. We'll close the strategy tester. And I believe a good example was February 12th on the 30-minute chart. Give me just a moment. Let's find that February 12th. And I'm going to get to the punchline for us so you guys can explore this strategy, see how you want to refine it, pardon me. So on Trading View, which is really cool, they have a strategy tester, or not a strategy tester, a replay function. So you can go back in time, do a little time traveling, and see what the deal is. Now let's change this down to the 30-minute time frame, because that's what my back testing log is based off of. We'll bring this back up, and we were looking at 7:30 a.m. is when the signal happened. Let me bring this. All right, here we go. Now this will hopefully bring it all home for us. Here is February 12th. This was the 7 o'clock candle. It was bearish. It was red. The next one was a bullish engulfing. And so for those of us that don't know, a bullish engulfing is when this green candle, now I'm going to break down 2 different things. And this is why I said it's important that you have your consistent and clear definitions. The formal traditional definition of a bullish engulfing is when this next candle, this one right here, the price starts below where this red one was, below where it closed, and it ends higher. That's the formal definition. Now, my definition, Curtis G, is Did this green candle travel farther? Was the price range greater than this red one? That's my definition of engulfing. So that's why it's very, very important that when you're setting up your backtesting log or your setup, you have your definitions clear and consistent for you. So for me, this was a bullish engulfing, even though the price didn't necessarily start below where this red candle ended, because it was bigger or because the price traveled further, I consider this an engulfing. So when we go back to the backtesting log right here, right, there were no bearish lead up candles, meaning that there was only one. There was one, or that's it. There wasn't two. And we can see another one right here. And then let's go back here. Did it occur above or below the previous day high? So this white line symbolizes the previous day high. And this bullish engulfing ended above the previous day high. So when I go to my backtesting log, I'll go ahead and filter down for all the instances that only ended above the previous day high. And now, once we filter down, look at the chances. The chances jump to 80% that the very next candle, the one that we enter on, is going to end green. And look what happened here. Boom. It ended as a green bullish engulfing or a green bullish candle. But what happened as well? There was some pullback. So what I know based off of my 30-minute bullish engulfing strategy, my highest probability setup is it occurred above the previous day high. There was only one bearish candle before it. And of course, there was a little bit of pullback. So once this candle opens up, I'll wait for it to dip down a little bit. Then I'll enter in, and then I'll just go ahead and ride this up. And then whatever your profit target is, that's up to you. As you guys heard me say, I like to aim for 5 to 10% profit targets on my scalps. And that's one of the strategies that I use there. But I was able to determine this highest probability setup by having this backtesting log. Let me go back down here. Here it is. By having this backtesting log, going through all of the instances, just logging them. Every time I saw it pop up on the chart, logging them all. Was it above or below the previous day high? Above or below the previous day 50%, which is this blue line here? And then was it above or below the previous day low, which is a bottom white line down here? Now, there is an indicator that we're going to touch on in just a moment that will automatically chart this out for you. Of course, if you've been on my TikToks, you know what that indicator is, but we'll get to it in just a moment. But we have several instances where you can go back and see every time a bullish engulfing appeared above the previous day high with no bearish lead up candles, there's only one, no more than one, that there's an 80% chance that the next candle is going to be a green candle. So that's a quick scalp. And that's essentially how you want to set your backtesting log up. Just change your criterion, right? The questions that you want to ask, make sure that you're just using ones and zeros. So one meaning yes, zero meaning no. And when you input the formula, it will filter down as you apply your filters. It will update the probability percentage for you to tell you the likelihood of success. So I want to give y'all a moment. It's a very simple formula. It's just the equal subtotal, parentheses 1, comma, and then all of the cells that are in that particular column. So if you want to make a note, of course, this is being recorded so you can come back to it. But that is the formula that you can put in each one of your criterions or questions. And once you do that and you go back and you do your manual back testing using zeros and ones, all you have to do is apply your filter. So just imagine it's a live trading day. You see your setup present itself with some of the criterion that you're asking, whatever variables that you think are important. You might just say, Tuesdays, or you might just say a particular time, or you might say RSI, or if you use EMAs, moving averages, whatever the things are that you like, add them here as ones and zeros. And then as you apply your filter, your strategy will tell you, okay, there's an 80% chance that it's going to be successful. Like I said, it's very, very manual, but it's also very simple. And what you really want to do, depending how often your setup presents itself, is you definitely want to get plenty of instances in here. I've had some people say 50 is enough. Some people say 100. I say the sweet spot is 100. It does take work. This wasn't something that I did in one day. This is something that I had to allocate 20 minutes a day to. All right, let me go do some back testing. Let me go do some back testing. And then I built it up over time to where I have a high level of confidence and I really don't need to do this too much anymore. Every now and then I'll add some more instances just to make sure that nothing has changed and it's still, maintaining that 80%. But any questions, any thoughts, any clarification that I could provide, y'all don't hesitate. You could come off mute, anything like that. This is just a simple way to set up a back testing log. Use ones and zeros, use this formula. That way, as you apply your filters, when your setup presents itself, it'll tell you, okay, there's 80% chance. Let's even change it for a second. Let's change it for just a moment, right? Let's just say there were bearish lead up candles. And that in and of itself drops it. Just changing that one variable drops it to a 56% chance that the next one is going to be successful. So now you guys can see why I like to look for that 70% threshold. So if I see my bullish engulfing happening, even if it's above the previous day high, if there was more than one bearish lead up candle here, let's say all these were red, I wouldn't trade it. Why? Because it doesn't meet my 70% threshold for entering in that trade. So I'm hoping that makes a little sense right there. But of course, if you have any questions, feel free to drop those in the chat or just come off mute. So that is how you build your back testing log. Like I said, I'm going to say it one more time because we had one or two people just join. It's a very simple yet very manual intensive way to build a back testing log. But once you do this, you're going to go through so much chart time, which you'll hear a lot of seasoned traders talk about, having chart time, screen time, letting your eyes get familiar. You're going to have so much of it that in a live trade, you'll easily be able to spot, oh, that's my setup right there. Don't even got to think about it. And that's what you want to have, right? And you get that by going back through and getting all of those instances. As y'all can see here, I went through almost 200 instances of picking out when this setup presented itself. All right, now we want to talk about developing a risk management strategy. The name of the game is longevity. Trading is a marathon, and you got to give yourself the ability to be in it for the long haul. Now, there are three ways that you can do this. Francisco says, bro, you're disciplined. Kudos, of course. And we're going to get disciplined together. I had to go through it the hard way. So I'm just trying to give y'all the cheat codes to get to the finish line without doing you a disservice. Because I could just give you the answer, but if I don't break down the rationale, you might think you could just jump to the end and you'll miss a couple key components. But big salute to you, Francisco. I appreciate you, bro. But there are three ways that you can develop a risk management strategy. It's going to be your position sizing, your trading management, and knowing when to take a day off. So let's get into that. All right, so here is one, and you can size down or apply it to your situation, but this is basically what I use right now. I use my account size, which determines my trade size, which determines my limit. So right now, my account size is about $10,000. I divide that by 10. And so each individual trade will only be about 1,000. And then my stop loss is around $100, give or take. It all depends because it won't be exactly on there. I don't enter in my stop loss on my broker. I'm somewhat of a conspiracy theorist. I'm one of those people that believe that the market makers, they use those stop hunt algorithms. So I know in my mind, I want my stop to be around $100, give or take on how the price action is. But for the same way, you can do that with a smaller account size. So let's say you only have 5,000. You can divide that and say maybe you will only take a trade that is about $500, and then your stop loss might be about 50. Now, this does lead me to one of the questions that I get asked all the time, which is how much money do you need to get started to trade? And what was that? Is it pronounced Kabrab? Kabreb? Oh, might be a little mute.
Yes, I'm sorry. I wasn't sure that I wasn't mute. Yeah. So sorry.
No worries, no worries. But what I want to get to is, so one of the questions that I get asked all the time is, how much money do you need to start trading? And while it's very true, you don't need a lot, I would say I would opt for $2,500. And the reason why that is having $2,500 allows you to break down a risk management strategy. So let's say if you have 2,500, you can break that down to $500 a trade, right? So that's 5, 1, 15, $2,500 or 2,500, pardon me. That gives you five opportunities. And what are the chances that you're going to have 5 back-to-back losses or straight up and down L's. And even if you had a loss on all 5, you're not going to blow your entire trading account because you have a stop loss. It's the same thing here with this, right? If you got a $10,000 account, if you're doing $1,000 trades, what are the chances that you're going to blow or have 10 back-to-back losses? Now, the reason why I'm kind of breaking down these two, the 5 versus the 5 or the 10, dividing that by 10 and all that kind of stuff, is in relation to that question. You guys have probably seen before, right? People say, well, you should only be trading with 1 to 2% of your account size and things like that. And it's very, very hard with a small account to have enough capital or enough trading size to where your profits feel very tangible, right? And we need a little bit of that, to have a profit where you can feel it a little bit. It keeps you motivated. So this is why I say at a minimum, you want to get to about $2,500. And if you have the $2,500 account size, dividing that by 5, so you're trading with about $500 each trade, and then having like a $50 to $60 stop loss. Now, one thing that I do want to notate and show you guys is if you don't have 2,500 bucks, it isn't an absolute end all be all. You can trade with less than that. But let's say you set that as a goal, right? Let's say you set 2,500 as a goal and you picked up a side job. I've done, you can go check out my Instagram. I've done Uber Eats, I've done DoorDash, I've done side hustles. Whatever you do to hustle and get to that $2,500 threshold, that money is going to mean much more to you than an easy amount of money that you get just tossed. And I don't want this to seem like I'm bashing anything or I'm talking down on anything, but one thing that I realize when it comes to the prop firms, while a lot of traders struggle, is my understanding with the prop firms is you pay 50 or 100 bucks or 150 bucks to enter in to do this prop trading challenge or evaluation. And then if you pass the evaluation, they'll give you access to 25,000, 50,000, $100,000 in live capital to trade with. Well, for a lot of us, not to, looks like we got a little chat right here. For a lot of us, not to scoff at any amount of money, because I never scoff at any amount of money, but for a lot of us, $50 or $100 isn't something that is going to deter us from making bad trading decisions. Whereas if you had to hustle up and really fight to get your 2,500, which is something that you're not just going to drop on a prop firm or anything like that, you're going to trade with a lot more seriousness because you knew how much of your life and how much of your time it took for you to get there. All right. So Francisco says, what prop firm do you recommend? I actually don't have any recommendations, Francisco. And it's not because I don't like them or anything like that. It's just I've never used a prop firm and I only know a little bit about them. So if I could recommend anything, I would typically try to say not to use a prop firm, only because I know a lot of traders go through blowing their accounts. And if you think about that, right, I don't know what the average cost is to do a prop firm evaluation or challenge. I think it's like 50 bucks or some could be 100 or $200. But think about the average amount of time that traders blow through those accounts and think about how you could have just saved all that money up to have it on your own account to trade with. That's my logic, my rationale. By no means am I dissing prop firms at all, because I see a lot of people starting to have success with them on Twitter, a lot of people that I follow. But I will say is I've been following and interacting with these people for a while now, and they've blown thousands of dollars worth of accounts. For sure, for sure. But if you feel
Thanks,
confident
bro.
in your, yep. Question, anything like that? All right. But yeah, if you feel confident and disciplined, if you know you're disciplined, by all means, do a prop challenge for sure. Because you know that the chances of you blowing through that prop firm money over and over is probably slim. You know you're dedicated and disciplined. All right. All right. So just kind of reiterating, I just want to reevaluate. At a minimum, I would say try to aim for that $2,500 mark for your account size. Of course, you could trade with less than that. But once you get to about $2,000, $2,500, it makes it very easy to structure your risk management when it comes to position sizing. And let's go back and let's go check it out, right? I'm going to show y'all. I want to show you over here. So look at these contracts for SPY, right? Look at how these contracts are. These are right at the money or in the money. This one right here is about $100. This one's 152, 220, 300 bucks. So just imagine, right? If you had a $2,500 account size and you're trading with $500 per trade, you could get 5 of these contracts right here, which allow you to sell 3 and profit, let a couple of winners run. You have a lot more flexibility with what you can do. But let's say your account size was only $400 or something like that. You could only get a few of these contracts before you're at risk of blowing your whole account. So when you get to that $2,000, $2,500 threshold, you get a lot more flexibility with being able to do risk management, being able to buy multiple contracts, being able to let some of your winners run. You get a lot more breathing room, is what I'm trying to say. All right. So the next thing in developing a risk management strategy is what I call trading management. And this is something that I greatly use that helps keep me in the game. Remember, the name of the game is longevity. For me, this is what I found that has worked the best for my trading success: a one and done. If my first trade of the day is green and successful, even if I didn't necessarily hit the profit target that I wanted, I am done. I close the charts, I walk away, and I go and do something else with my day. If I take two trades that are losses, I'm done. Two L's and go. The reason for that is at about that second trade mark, you are going to be revenge trading. As much as you think that you're not, your mind is going to be revenge trading. And there's two battles here within that you're going to go through. You're going to either A, try to at least get back to break even, or or B, you're going to take more losses. After two, just realize that is not your day. Step away from the charts and allow yourself to go refresh. More trades does not equal more money. Please, please, please. I know it sounds corny and cliche. You probably heard a lot of traders talk about this or say it before, but typically, the more you're trading, the more you're losing. So for me, my rule for myself is if I take two L's, that just tells me straight up, it's not the day, it's not my time. Let me go ahead and get out of here. And of course, no setup equals no trade. And please, please, please hear me when I tell you it's going to be very, very tempting, especially if you follow certain trading communities, if you're on TikTok, if you're on Twitter, if you're on Instagram, or whatever the case may be, and you see people talking and chatting about, oh, yeah, I'm in this and such is booming off today, or this or that, or whatever. If those ticker symbols do not present your strategy that you've developed for you, do not trade it, right? Do not trade it. Now, the reason why I'm saying that, especially in relation to all these three rules right here, my risk management strategy, is because if you are successful, if you are profitable trading when you shouldn't have, it is like a drug. And basically, you are rewiring your brain to develop and engage in bad behaviors, detrimental behaviors. So imagine if I took two L's and then on my third trade, it was a profitable trade, right? And I started to think, okay, I could just keep trading more. There are going to be days where it doesn't work out in my favor. Let's say I take a trade and it wasn't a part of my setup. Yeah, you were profitable, but now you're going to open yourself up to this idea that you need to be doing different strategies and doing all that. And without having the back testing, the confidence, the rationale, the understanding, you're rewarding yourself for bad behavior and it's going to be very, very problematic. Trust me when I say this. So if your setup isn't there, don't trade it. Now, if you see people talking about a GameStop or a whatever ticker symbol and it's perfectly in alignment with your setup, yes, by all means, trade it. But do not set up a behavior that tells you, that rewires your brain to break these rules. At least for me, right? One and done. I don't want to give my money back to the market. And that's really all you're doing. If you have your first trade and you win, it's profitable. Just imagine this. Now you're risking what you've already been given by the market. You make $200 on a trade or $5,000 or 750 bucks. Just imagine you've got that. All you got to do is walk away and you win for the day. But if you decide to take another trade and you lose it, what is that going to tell you? Right? Most people are going to go through, oh no, I got to get that back. Now you're in revenge trading. And so more than likely that next trade isn't going to be profitable. Now you got two L's. You need to just go. But now you're angry and you're upset with yourself because you started off good. Now you're going to start getting into setups that are not for you. And you're going to start engaging. It's a very quick, slippery slope. It's like an avalanche or a snowball, how this happens. So that's why I set up this kind of like triangle offense or defense. One and done, two L's and go, no setup. I don't trade. And if you look at my Discord, there are days where I don't trade. And I know sometimes for the community, people are constantly looking for what's the trade of the day, what's the trade of the day. But if I don't find the setup, if I don't see it, no trading. And remember, the name of the game is longevity. So just remember or think about it like this: when you're not trading, you're protecting your capital. And remember, you need capital to trade. If you don't have capital, game over. All right. So the last part of developing a risk management strategy is knowing when to take a day off. So here's a screenshot from my TradeZella journal. And so this is from the start of the year. I've had 71 winning days, 34 losing days, 2 days where I broke even, 0 logged days. I'm not too sure what they mean by that. And then it may be because I don't enter notes. I use all my notes on my Excel. And then my max consecutive winning days is 8, and my max consecutive losing days is 3. So I want you to understand the importance of taking a break, even when things are going good or when things are starting to get bad. The ability to give yourself time to refresh is key. Hey, James, how's it going? All right. So why I'm saying that is, for me, what I've had to learn the hard way is once I get to about 8 trades or 8 winning days, I've had to learn I need to just take a day off, just cool off for a bit. Just in December of 2023, for the first 2 weeks, the first 15 days in December, I was hot. Every trade, getting it green, green, green. And it wasn't even a matter of me becoming cocky or just thinking that I couldn't miss. It was just a matter of I needed to let my eyes refresh. What happens is, as you get into a certain slump, whether it's a winning streak or a losing streak, your eyes become a little blind to some of the factors that you need to account for. So it's very, very important, even when you're winning, knowing, hey, I need to take a break. And for me, I've seen this time and time again. Once I get to 8 winning days in a row, about a week or so, I need to go ahead, no matter how good things are going, just take off a day, ease off the pedal, let my mind and my eyes refresh so I could come back in and re-account for some of the different market factors, right? Was there Jerome Powell and FOMC? Was there an earnings release date? Was there some news that shifted the market or the stocks that I like to trade? Being able to refresh is good. And it's the same thing with your losing days. I know it's easy to understand, but after about 3 days, or for me at least, once I get to about 3 days of losing or 3 back-to-back days, or maybe it's 3 back-to-back trades, I know that I need to go do something to allow my mind and psychology to refresh. So this is just my threshold, but you'll be able to determine this by having a trading journal. See how it all ties back in. Being able to go back and look at your data is going to be key. And so for me, just at where I'm at so far on my journey, after about a week of wins, I know it's time to cool off. After about 3 back-to-back days of losses, I know it's time for me to take a break and refresh. So I want to go back and just reiterate, just so we know, that there are 3 components that you can use to develop a risk management strategy: understanding your position sizing, your trading management, and knowing when to take a day off. So Francisco says, what's the longest you've taken a break? I think the longest I've taken a break trading since I got into it seriously, so we'll say since January of 2023, probably 2 weeks. That's probably been the longest that I've taken a break. 2 solid weeks of no trades. All right. So we'll roll through that. I appreciate the questions. No matter what question pops in your head, don't hesitate to ask me, y'all. Okay, so now let's talk about some daily indicators that I use. I use the SSS 50% rule indicator, which we just kind of saw with the bullish engulfing strategy. I use the Strat Assistant. Not that I necessarily trade the stat, but I like to have the indicator on there because there's one important detail that it tells me: support and resistance zones and sector ETFs. So let's go ahead and get into those on TradingView and break those down. And they're pretty simple. They're pretty straightforward. So right here, what we see, and I'll show y'all. Let me go ahead and move this to the side. So I'll show y'all right here. The first one is the SSS 50% rule indicator. I think that was 3 S's. So if you're using TradingView, this is what it looks like. This is the exact one. Now, you probably heard me say this before, but the woman who developed this, her name is Sarah Strat Sniper. She's a very awesome lady. She has a YouTube channel and she's on Twitter. So if you're on either one of those platforms, you can reach out to her. She's really cool. She'll respond and things like that. but she created this 50% rule indicator. And what it does is it automatically goes back and looks at the previous day high, the previous day 50%. So where was the middle of where price traded or traveled for the day, and then the previous day low. Now, what I found in my trading is that for the most part, at some points during the day, one of these three levels is going to be acknowledged by price movement. So back here in February, around February 12th, looking at that bullish engulfing strategy that I was showing y'all that I'm going to touch on again, right here, February 9th, it created this high of the day. And then we get to February 12th, and look how it kind of just somewhat respected it, right? It tried to get up here. It tried to get up here. It had a little bit of resistance. It finally broke through with this engulfing, and then it came back down. And then what we saw was that price didn't want to go below the previous day 50%. You see how it respected it. So it will be, at least from what I've seen, most tickers, especially SPY and the ones that are a lot of volume and high activity, one of these three levels is going to be acknowledged and respected. So it allows me to be on guard about potential resistance, potential support, and things of that nature. Let's go ahead and we'll end the replay, and let's just see how that kind of holds true for present time. All right, where are we at? I think where is SPY at? SPY is at 542. It has been a run up. It has been a run up. All right, so here we are. Let's just take a quick look. This is present day. I should have just used the magnifying glass to make this bigger. Okay. Now, and to make this a little bit easier to see, I'm going to turn on the extended trading hours, which is going to mark out the pre-market and aftermarket in this blue and yellow. So the blue means aftermarket and the orange or yellow means pre-market, right? So here we have, this is Friday, June 14th. And we've got the indicator turned on, the 50% rule. So this was Thursday's high, this was Thursday's low, and here's the 50%. Now look at what happened on Friday when on the 30-minute chart, right? When the market first opened up, it had a hard time trying to break through or bust through this 50%, a hard time. It stayed through that about half the day before finally breaking above and then still gravitating around it. So like I said, each day these levels are acknowledged in some form or capacity, either the previous day high, the 50%, or the previous day low. So that's one of the indicators that I use on a daily basis. And I use it just to keep me on guard, right? Just to see, like, if there was a gap up, way up, then we know, or more than likely, there's going to be a chance that the previous day high acts as support. If there was a gap down below the previous day low, then we know that there might be a good chance that the previous day low is going to be an area of resistance. So that's the reason why I keep that daily indicator on there. And then now let's talk about the Strat Assistant. So the Strat was created by a gentleman by the name of Rob Smith. All right, we got a question here. Do indicators come with TradingView or are they plug in? So it's a mixture. There are pardon me, Francisco. Let me go back here. So there are a few ways that there are indicators in TradingView. There are indicators that literally the TradingView company team have created and built themselves, and then it's open source. So there are people, traders in the community that create indicators, and then they decide whether or not they want them to be free or open access to everybody. Sarah Stat Striper, this was her gift to contributing to the trading community. So she made hers free and anybody can use it. And then there's a third category. There's a category where there are certain people that have their own trading communities and they build their own indicator and they only have it available to people that are a part of their community. So you'll find a mix in here. Most of the ones that are on mine, even though 90% of these I don't use, these are all free indicators that are for public use. There's probably like 2 or 3 that were like pay or you have to be a part of a community. But that's basically the essential setup. So you have those that are created by TradingView themselves. You got those that are created as open source or free, and then you got those that are kind of exclusive. All right. So what we were just about to get into was the Strat Assistant, right? All right, so let's talk about that Strat Assistant really quick. Let's go back over here. So as I was saying, the Strat Assistant was created by a guy by the name of Rob Smith. And Rob Smith unfortunately passed away, but he created this trading methodology known as the strat. Now it's very simple. I'm not going to get too much into it, but it essentially just tells beginner traders or people whose eyes are getting familiar with looking at candlesticks what direction the candlesticks were. So twos, which you see at the bottom of the candlesticks, are directional. And basically, the way the strat works is it's based off of the previous candle. So this two that's green lets you know that it went above or up based on the previous one. This two that's below lets us know that it was bearish based on the previous one and it went below the previous candle's low. If you see a three, that's an outside candle, and that just tells us that the range of this candle went above the previous high and below the previous low. That's the long and short of how the strat works. Now, there's some combinations and there's a cheat sheet out there that you can use, but I don't explicitly trade the strat in terms of those combinations. What I like is this full time frame continuity indicator right here. So I like this because it tells you on all time frames, is the stock bearish or bullish? So right here on the 30-minute, it's bearish. On the hour, it's bearish, meaning it's below where it was at an hour ago. It's below where it was at 4 hours ago. But on the daily, weekly, monthly, and quarterly time frame, it's all bearish. And typically I use this as just a piece of my mind frame or my thought process if I'm thinking I want to take puts or calls. So if something has full time frame continuity to the upside, then I may be a little hesitant to take some puts because that's a strong indication that there's bullish momentum and the bulls are dominating. And on the opposite side, the same thing. If something has full time frame continuity, all red arrows pointing down, full bearish time frame continuity, then I may be hesitant on if I want to take calls. But it may give me more confidence if I'm entering puts. Yes, I know the bears are in control. The bears are pushing everything down. It's below where it was 30 minutes ago. It's below where it was an hour ago. It's below where it was 4 hours ago. So what I like the strat assistance for is it tells me about the full time frame continuity. So I usually use it as a caution or a boost of confidence if all these arrows are the same color or the same direction. That's the reason why I use the strat assistant. Not necessarily for the direction of the candles, just to get an idea of how bullish or bearish we are with the market or that particular ticker symbol. All right, next is support and resistance zones. For sure, Francisco, no problem. Support and resistance zones is another daily indicator. Let me go back here before we get into the strategies. And so support and resistance zones are one of the very few leading indicators that you can use or that are available in the market when it comes to trading. Most indicators are lagging, meaning that they can only tell you information after the price has moved and after price has happened. But support and resistance zones or areas are one of the few indicators that can tell you potentially before price even gets there. So let's go take a look at examples. Let's go take a look. Let me bring back that trading view. All right. All right. So we'll start off with the key example that I gave last night, and then we'll move into some other areas. So this was a big one. Big shout out to Torrance, who's on with us right now. He was the main one that helped me, that spotlighted this trade with Home Depot. So one night we did some charting just to map out what was going on with Home Depot's price. This is the daily chart, meaning that each one of these candles represents one day. And so I'm going to give back the replay function. We were charting this on the 5th. So this is what the chart looked like when we first were doing our charting. I'm going to squeeze it in just a bit. But what we saw here, if we go back in time, as you can see with support and resistance, was that Home Depot was respecting this level, right? Here we go on the left-hand side of the screen, all the way back to August of 2022. It came to this level and then it pushed back down. So it acted as resistance. It came back to this level, had a hard time getting above it. Even if it broke above a little bit, still a hard time, and it came back down. So it's still resistance. Same thing as we fast forward to August of 2023. Look at that. 1 year later, still a strong area of resistance for Home Depot. And then eventually, once it solidly broke above this resistance zone, it became support. So here's a note for us new traders out there. Something that I strongly believe is that support becomes resistance and resistance becomes support. So here we are going into 2024. It finally breaks above this resistance zone, and then it came back down, tested it a little bit, didn't want to break below, and now it's a support zone. So Torrance have pointed this out to me. He had been analyzing and checking out the price movements of Home Depot. He also had some fundamental analysis about understanding how Home Depot performs going into the summertime, which is right where we're at. And then we have these gap ups to the upside that showed, okay, it's setting itself up for a prime move upward. So what we did was we got in, which is where this green line is, having a strong level of confidence that this was a support zone. And if you like to use candlestick patterns, this is starting to form a double bottom, right? We got a bottom here. We got a second bottom there on the daily chart. You use like this kind of neckline or the middle of the W. If you guys can see that, right? How many of y'all can see that this was forming a double bottom or a W? You can drop a one in the chat just to let me know. But all of these indicators, which is known as confluence, when several different strategies come together to point in one direction for you, that's known as confluence. All of these pieces of confluence were coming together, showing that Home Depot was primed and ready for an upward move. And so the key thing, the basis of looking at this trade, which gave us a heads up ahead of time, was the support and resistance zone. So now we can go back and take a look at maybe some other tickers. Let's see. Let's go and look and see if we could find something just with SPY. I'm just going to kind of turn off the extended hours trading, go back to regular hours. We're on this daily chart. All right, so we're in a new kind of area, but don't want to cheat. I don't want to like cherry pick, but let's see if we can. Let's see how we can do this without really looking ahead, with this crazy bull market that we've had. Very, very crazy bull market. All right, here's somewhat of an area. I don't know if you got your eyes could quickly point that out. And one note I want to say is a lot of times when we're first learning about charting, right? We kind of learn that we draw a line or a single price point for support and resistance. What I have adopted is to draw a zone, a rectangular area of where price likes to travel between. That gives me a bit more wiggle room, and I'm not putting so much emphasis on a singular price point that can easily kind of move past it or move below it. I was trying to do this in a way that it didn't seem like I was cherry picking, but just want to show something similar to about right here, what we kind of see this being a support and resistance zone kind of with SPY. So here we are back at May of 2024. We see on this daily chart, SPY came into this support zone. It's respecting it, then it finally breaks out, and then it comes back down into it again. And here we are, support. It respects it, and then it breaks out, right? Let's see. I don't think because we've been in such a crazy bull market. Look, I didn't even see this. I hope you guys understand. I wasn't cherry picking or anything like that, but here we go. Look at this right here. If we draw our support and resistance zone across, look at that. And I know it's somewhat of a range, but look how SPY still respected it. This was at one point a resistance zone, even though we had this crazy breakthrough. Overall, on the daily chart, this zone was resistance. It was resistance. SPY got up here and then it came down. SPY got up here and then it came down. Now, charting support and resistance is very subjective. It is based on your eye. But ultimately, what I will say and what I did say is that it's one of the very few leading indicators. So as you get better at charting support and resistance areas or zones or lines, it's one of the few things that could potentially tell you what area price is going to respect before it even gets there. So that's one thing that I like to use on a daily basis is support and resistance zones. And I'll say it one more time. It's one of the few areas or one of the few indicators that's a leading indicator, meaning that it tells you before it happens, as opposed to a lagging indicator that gives you the data or the signal after price has already moved, after price has already done its thing. Okay. And then we have sector ETFs. Now, the reason why I have that as a daily indicator is if you're looking at a 111, we got ones, yes, yes, yes. If we're looking at sector ETFs, you can use this potentially to see which stock is carrying that sector or a market that you could potentially get into, especially if it's already on your daily watch list, right? I shouldn't have done that. I should have stayed in that presenter mode. Let's get back to it. present that full screen. Let's get to that present. All right. So sector ETFs, let's go back down over here to our trading view. Now, in trading view, or not even just trading view, but for the most part, the market is broken into, or is not for the most part, the stock market is broken into 11 sectors, right? There's consumer staples, consumer discretionary, there's financials, there's healthcare, there's IT, there's communication, so on and so forth. Those sectors all have a corresponding ETF, and the ticker symbols all start with X. Here's a couple of them that are already on my daily watch list. If you look over to the left hand side of the screen over on TradingView, XLE is the energy sector ETF. XLF is the financial sector ETF. So it consists of all the banks, and then XLE has like all the oil companies like Exxon, Chevron, things like that. Now, the reason why I like to use that as an indicator is because let's say you see that XLE, let me move this over a little bit so we can see it. Let's say that you see that XLE or XLF is having a bearish day. You could either trade that particular ETF directly, right? You can do some options trading, but remember, like I said, for us beginners out there, or anybody who wants the confidence and the ability to get in and out of their trade, we want high volume and high options trading activity. So we'll go to XLE for a second, right? And with XLE, we'll bring it to the daily chart. Let's just take a look. Let's just take a look right here. So not too bad. You know, there's still millions of shares that are traded specifically of the ETF XLE for the energy sector. But when we compare that to SPY, remember SPY had tens of millions. It was in the 40 millions. So that liquidity gives us confidence that we'll be able to get in and out of our trades. I've traded XLE before. As we see, it's on my daily watch list. But the reason why I have that as a daily indicator more so is it could tell you like ExxonMobil might be the company that's dragging the sector or the ETF down. So with that being said, you can get in there and see, okay, do I want to trade ExxonMobil because something's got to be dragging down this ETF? Kind of like how we know Nvidia and Apple and Microsoft, right? The $3 trillion companies, they're the reason why the S&P 500 and the overall stock market is being pulled up. So you can look at those three for more trading opportunities as opposed to just looking at SPY, right? You can go either or. You could trade SPY, or if you wanted to see some more trading opportunities, you can look at the individual stock. And so that's the same thing that you can do with all the ETF sectors, right? XLE, XLF, oh, there's a bunch of the 11 other ones or the 9 other ones. So let's say you don't necessarily see your setup, right? Because some of these candlesticks will look different or they'll appear different on the sector versus the stock market, right? But if we take a look at ExxonMobil, let's let the data bring up about the same amount as shares, 15 million daily on the daily, but it does give you an opportunity to see what is pushing this sector down. And another reason for that is, as we see here, right? XLE went down 66 cents, whereas ExxonMobil went down 93 cents in the day. And of course, when it comes to options trading, you want to put yourself in that ability, especially if you're getting a trade that's going in the direction of the market or the particular ETF for the stock. The wide range, right? The more the dollar price travels on the underlying stock, the greater the value change or increase will be on your stock options contracts. So I'm saying all that to say because it made sense to me when I was trying to understand why some people traded QQQ versus SPY. And I asked a couple of traders that are like seasoned veterans, and they said, even though for the most part, SPY and QQQ will trade about the same, right? Their movements will look pretty similar. QQQ has a wider price range that it travels, where SPY might only travel $1 in movement in range a day. QQQ is going to travel $2 to $3 or $4 in a day. Even though the charts look the same, there's more range and movement with QQQ. And of course, if you got more range and movement, then you have a greater impact to your contract values. It works both ways in terms of profit and potential losses, but you can use the ETFs to see, okay, is there a stock in here that's really dragging down the market, that's acting as an indicator for which way things are going to go? And so that's why I use these sector ETFs as an indicator for myself. It'll let me know, okay, if XLE is down, well, what stock in XLE is already a part of my daily trading list? Oh, ExxonMobil. Let me take a look at ExxonMobil to see if there's any setups there that I can take. All right, Francisco says, what do you do first? Do you like to see the company first or SPY? At this stage in time, Francisco, I'm looking at the company first. I really haven't traded SPY in a little bit or any of the ETFs. I'm looking at the company first, and there isn't any particular rationale. That's just kind of how my trading has been landing lately. But I will say at a certain point, I'll toggle between the two if I'm really trying to analyze the trade. But as it goes right now, I'm typically defaulting to the actual stock itself. But there's no wrong or right way. You can look at the sector first, or you can look at the individual stock. Now, the cool thing is your eyes are going to get used to this phenomenon that happens, which is I'm not the best at it, but it's worked out a couple times, right? When the sector is going a certain way and is being pulled down, and I'm pretty sure this logic is easy for all of us to understand, but when the sector is going a certain way and all of the stocks within that sector are starting to go down, you could potentially find some laggard stocks that are kind of slowly following behind, right? Kind of think of it like a mama duck with her ducklings. You see the ones that are right close to the mama duck, they've already committed their action, but the one in the back may be the one that you could jump on because there's a high chance that it's going to follow it. So for instance, let's say we see that XLE is coming down. We see ExxonMobil is going down with it. We see Chevron is going down with it, but maybe another oil company hasn't quite started to tip yet. You may be able to look at that company and get ready for its bearish move because it's going to follow all of its siblings that are in that sector. I've been able to do that a couple times. It does take some skill set. It does take refining of your strategy, but that's one way that you can use them as well. Looking for which ones are lagging behind because more than likely they're going to follow their siblings like the mama duck and the duckling. Right. Appreciate that. Appreciate that. Let me move this over a bit. Let's get back to this. Okay, almost there, y'all. About to wrap it up. I was hoping to knock this out a bit faster, but all right, here's 3 trading strategies that I use. We went over that bullish engulfing. So for me, I look for bullish engulfings that are on the 30-minute chart that occur above the previous day high. And as we saw in my back testing log, I went through 200 instances, and we know that when this happens right here, there is an 80% chance that this candle that we enter on, right, is going to be green or going to end the way that we want it for entering calls. And then I have what's known as mountain highs and valley lows. And this is essentially just hammers and shooters that signal a potential reversal. So the way I think about mountain highs and valley lows are in a couple of ways. I'm looking for sharp V's at the top, like getting to the top of a mountain. So if you've ever gone hiking, you get to the top of that mountain, you're at the peak. What happens when you get to the peak of a mountain when you go hiking, right? We know that after you check out the view, it's time to go back down. Same thing at the beginning of a hike, right? When you first are at the trailhead, when you're at the bottom and you're in that valley low, the price for the most part has no choice but to go up. You're looking up at the top of where it was. Where's the mountain peak? Where's the view that we're trying to get to? So when I see these deep V's starting to form on a chart, I look for a shooter or a hammer to be able to get in and then take my trade. Now I use this in conjunction with the back testing log. So if we go to the back testing log, let me go ahead and pull it up. I have one right here. I do all symbols, mountain high, valley lows. As y'all can see, just like I said, I have 200 instances where I've gone back and manually charted them out. Now I'm going to make sure I have no filters. Right, there are no filters on my chart. And here are some of the questions that I asked, right? Was the signal candle bullish or bearish? Of course, I remind myself if I was looking to take calls or puts. Now, going back to using that strat assistant, remember I told y'all, was there mainly bullish full time frame continuity or was it mainly bearish full time frame continuity? And then I asked myself some other questions. You don't necessarily have to ask yourself that, but I have some other things like, was it corner to corner? I can kind of explain that if you guys want to know. I don't want to inundate you with too many details, but here are the key ones, right? Was it above or below the previous day high? Above or below the previous day 50%? Above or below the previous day low? So you guys can see with that Sarah Strat Sniper, why that comes into play with my strategies and my setups, because I include it in the questions that I ask on my backtesting log. And then I have some other things, right? Like I said, with my bullish engulfing strategy, I know that almost 90% of the time, 100% of the time, there is going to be some pullback on the entry candle. So that lets me know, don't be so inclined just to jump into the candle right when it opens, because more than likely there's going to be some pullback. And what has happened with me before is I've gotten right into a candle and then immediately I start getting scared because the price starts dropping. That bottom wick starts to form, or even that top wick starts to form if I'm looking to take puts, but it starts to move up. So I understand now that there's like a 99% chance that as we can see here with this little picture that I have, right? Almost every candle is going to have some wicks to it. So I know, give myself a little bit of time. The market is quite tricky. You might see a candle open up and shoot up, and you're thinking, dang, I'm going to miss the move. Trust and believe. There's a 99% chance that it's going to come back down and dip below and give you an opportunity for entry. But speaking to my strategy here, right? What I call the mountain highs and valley lows. Let's just say I've got all of my backtesting instances here. I'm just going to kind of go through it. We might even go in trading view, but let's just say my signal presents itself and we'll just say a bullish green hammer that presents itself, right? So now that I put that filter on, I can go down here just by entering one by one. And like I said, it's a very easy yet very manual way to do this. It lets me know that there's a 76% chance, just if there's a bullish green hammer, that the next one is going to be green, right? That the next candle that I enter on is going to be green. So at a minimum, we want to see, right? We want to see that the threshold, at least for myself, some people, they look for a 60% threshold. Some people look for a 50% threshold. For me, I would like a high level of confidence. So I look for 70% or above. And then let's just say that for whatever reason, it occurred below the previous day high. Remember, zeros is no's, and it occurred below the previous day 50%. Now let's see how it updates. So now it's an 82% chance that if I see a bullish green hammer that occurs below the previous day high and below the previous day 50% level, there's an 82% chance that that next candle, the one that I enter in on, is going to end green and I can scalp calls. So that's one strategy that I use, which is mountain highs and valley lows. Like I said, once you get to so many instances of logging this in your backlog, it's going to be built in your mind and you'll no longer need to do this, but you've got to go through the exercise. This simple yet kind of grueling repetitive exercise is very easy, but it is a little grueling. Once you do this, you'll be able to spot your setup so easily without even thinking about it. Think about the movie The Matrix. Remember in The Matrix when Neo couldn't really understand what the numbers and the letters and all looked at, but the people that were already in the Matrix for a long time, they could see the code, and the guy was like, oh, that's a woman wearing a dress, or that's a guy carrying a briefcase, or that's a green car, or that's a building. Remember, he could see it right away. And it's the same thing with this. Once you go through the practice of building your backtesting log or your strategy, you'll be able to see your setups right away and you won't need to rely on this, but you have to go through the practice and the exercise first. So if we go here, and remember, no strategy is 100%. But if I wanted to break it down, let's just take a look. We'll go to, because it was mainly based off of SPY. Did I exit already? Let's just chop it up. All right. Let's just see SPY. And remember, I like to trade on the 30-minute chart, but you can apply it to different time frames. You might want to add some different parameters, especially for those of us that like to use some of the other indicators. You can add those as parameters to your columns on your backtesting log. But look at that, right? I didn't cherry pick it. I hope you guys understand I didn't cherry pick at all. But what we just say? A hammer. Here's a bullish hammer right here that occurred below the previous day high and the previous day low. And the next candle was green. It definitely had a pullback. So all I had to do was wait for this pullback, right? I could go back to my back testing log to tell me what the average amount was for a pullback, which is about 28% or 28 cents. So I could wait for maybe near 20 cents or something like that for this pullback, enter in my calls, and then know that there's an 80% chance that this candle was going to end green, take my scalps and go. So that's how I built out my back testing log. That's how I use that strategy, mountain highs and valley lows. You can see here, look at this. We had this mountain high. We're at the top of the mountain. We came down a nice V shape. We came down into this valley low. That's our signal right there. There's that bullish hammer. We enter, take our quick scalp, and go. Don't get greedy, because then you had to deal with a little bit of this retracement. You had to have high risk tolerance, but eventually it came back up. So I hope that makes sense. Let me know, you guys. Put a 1 in the chat if that makes sense. That particular strategy, that particular style, mountain highs, valley lows. Y'all drop a 1 for me just to let me know that that makes sense right there. Or if we have any questions that I can clarify, please, please, please let me know. All right, we got a 1. Thank you, GG. Appreciate you. All right, all right. Now let's get on. Almost there, y'all. We got a 1. Thank you so much. All right. And the last one is support and resistance zone, which I've already gone over. You guys have seen me break down this Home Depot trade a few times, especially if you're on the live, especially today. We broke it down. Let me see if I can find another example. We can go to the Discord. And like I said, the support and resistance zones are one of the very few leading indicators. But if we go to our trading chat room, let's see some of the ones that I want to find. One that I haven't already talked about, especially if you were on my live last night, one that could have been a success. Let's go back far. Let's go back far. I think we talked about the Goog. Did we talk about that already? All right, all right. Let's see where are we at. Where are we at? Here we go. This was a beautiful one. This was a beautiful one that we played a lot. This was Amazon's double top. This was back at the end of May, and I was watching this for weeks, letting this play out. But what I have right here, let me bring this up. This orange area, my eye caught this as a certain support and resistance zone. And I knew that if Amazon broke below, we were going to come all the way down to fill this gap right here, right? But imagine Amazon had created this support and resistance zone weeks before it actually happened. So it gave us a strong indicator, right? A couple of times, a few times, that this was going to happen. Now, the way that we played this was, let me go to trading view on the daily chart. Actually, let me start back with the Discord. All right, let me go back with the Discord because I think I played it a couple times. We played that downward trend a few times. Let's see. Here we go, May 23rd. I have it right here on my charting notes for Amazon. Looking for the continued move to the downside with the bounce down rejection off of the trend line. The same moves I set up we've been trading this whole week. So here's an example with that Amazon right here. Let's let that pull up. Of course, Discord giving us just a little bit of a, here we go. See, it was even before then. We were playing this all the way down. And even when you're charting out your trend lines, those act as support and resistance too. So let me go back to trading view and show y'all. All right, let's go ahead and pull up Amazon. Let's see, let's see. Let's get back to that daily chart. All right. Now just imagine, I want to spotlight over here, right? We've, this last day, Friday, ended as a bullish green hammer. Now you could take my same backtesting log, right? I did this for the 30-minute time frame, but you could take the same backtesting log, apply it to the daily time frame after you've done your backtesting to see what are the chances that the next day, right, would end as a bullish candle or a green candle. And you could go back through and do the same things. Okay, what's the average amount that the candle pulls back? And do all of those factors that are important to you when you're building out your log to give you that probability, that chance right there to see, is it going to be an 82% chance? Because it's all data. Remember, it's all data, and that price typically has a pattern. That's why all of these strategies, to some degree, they all work, and to some degree, they don't work. So once you've collected enough data, you can just plug that into a backtesting log and then just have it filter down for you. But what we played right here, let me kind of bring back the replay function so we can kind of clear this out, right about this time, was it? So what I simply did was I start off on the daily time frame. We start off on the daily. I do a little trend line. Of course, trend line, support and resistance zones, they're all subjective. I start off on my daily time frame. I draw a nice little trend line down. There's a little bit of laggy Simpson. Computer's lagging just a little bit, but I do a little trend line down. Now I do the rough trend line on the daily chart, but then I come down to my 30-minute chart and I tighten it up. And I'm hoping y'all can see exactly where I'm going with this already. Here we are on the 30-minute, but you can do it on whatever time frame you like to trade on, the 4 hour, the 15-minute, the 5-minute, whatever the case may be. But what we see is, right, this kind of pattern of behavior, Amazon hitting this line, which can act as support and resistance, and then it bouncing down. Then you got to be patient. You got to be patient. Amazon hits this line, and then it bats back down. Amazon hit this line, and then it bounced back down. So when I put in my charting notes, I was waiting for Amazon to hit the line, because once it did, I entered into puts and then I caught that move down. Simple as that. And so you can see support and resistance even on your trend lines, whether you're trending downward or trending upwards. And then you could do the same thing on the flip side, right? Draw somewhat of a pricing channel or a wedge. I always feel like they're somewhat the same between a wedge or pricing channel and a broadening formation, even though they have their own distinct definitions. They all kind of tell us the same thing. We're kind of like ping pong, right? Kind of like ping pong. Where is price going to bounce off of? Bounces here, came down, bounces up. And so I'll say this one more time. I know I sound like a broken record. This is a subjective thing, right? Charting out your areas, your support and resistance zones, or your trend lines, but you'll get better and better at doing it, or you'll get more and more refined to your style, right? But that's essentially the long and short of how we played Amazon during this whole time. We played it all the way down, and I called out, okay, this is what I'm looking for. Puts if it bounces off the line here, or calls if it bounces off the bottom. So that is another strategy that I use with the support and resistance zones and the trend lines. All right, now here's some straight up resources that I want to give y'all just to wrap it up. There is a trader. He is probably my all-time favorite trader by the name of Kia Kili. He goes live on Twitch at least 3 times a week, if not all 5 days. But of course, we're all humans. We all have different priorities. But for the most part, he goes live on Twitch 3 days out of the week, and he offers a lot of rationale in terms of what's going on with the market, a sector, a specific stock. He makes everything make sense. You can ask questions in the chat. He responds to his chat, even with a lot of people being in there. So if you have a basic question or if you have something like that that needs to make sense, he's a great resource. And so the reason why I share these is because I'm not a gatekeeper. I want you to be able to have access to multiple sources of information that's going to help you with your trading. And so Kia Keeley is one of the ones that I definitely listen to almost every day or on a lot of the days during the week. And then, of course, Trading in the Zone by Mark Douglas, this book here that you can see. And so this book helped me truly shift my mindset and my psychology when it comes to trading. And then there's this book, Emotional Intelligence. So I want to end this with just a few quotes from each book, just to tie it all together. And so in Emotional Intelligence 2.0, this book shows the direct link between EQ, which is basically your emotional intelligence score, and your annual income. There are 2 tests that you can take in this book to measure your EQ score for improvement. But I highly recommend this book because this was the one page that really did it for me. It says that the link between EQ and earnings is so direct that every point increase in your EQ adds to a $1,300 annual increase in your salary or the money that you make. And I saw this both in my trading world and in my 9 to 5 world in my job. After I read this book and I took the test and I did the things that they were talking about, I got a raise, I got a promotion, I was able to get my next role. And then when I took it a step further and really tried to apply it to my trading greatly improved. So Emotional Intelligence 2.0, it has 2 tests in there that are going to give you 4 different scores. You'll get your baseline scores, you'll read the book, you'll implement the strategies that they tell you based on how you scored, and then you'll test again later in the future. They'll send you a reminder, and then you can see how you improve. So just imagine if you got a 55 in one area, and then you got a 65 again when you retook it, that's a 10-point increase. You could take that 10 points, multiply that by 1,300, and where do you at? About 13,000. So think about that when you really tap in and understand your emotional intelligence and your psychology. And then I have a few quotes that I wanted to read from Mark Douglas's Trading in the Zone, because these were ones that really hit home for me. So the first one, he says, at a subconscious level, our minds will automatically alter, distort, or specifically exclude information from our conscious awareness. In other words, we don't know at a conscious level that our pain avoidance mechanisms are either excluding or altering the information being offered by the market. Now, one way that I equate that to is how many of us have wrote an email or a text message or you wrote a paper for school and you could have swore that when you were reading it and proofreading it and checking it, everything was spelled correctly and all the grammar was right. But lo and behold, after you sent that email or that text or you wrote that paper, there were some errors that your eyes didn't see. It's the same way with trading. When you're in or out of a trade, our subconscious is so powerful that it will blind you to things that you should be taking into account or that you should be seeing. And a lot of times, what happens is we're blinded before we enter a trade. So all we see is all the good things. Then, when we get into a trade, we're also only looking for the good things when clearly the trade is working against us. So that's one thing that I wanted to show because it's easy that our psychology and that our minds will blind us. Another quote from the book he says is the most efficient path to discovering what you need to be successful is to develop a winning attitude because it's inherently a creative perspective. Not only does a winning attitude open you up to what you need to learn, it also produces the kind of mindset that is most conductive or conducive to discovering something no one else has experienced. Now, I'll give you guys straight up and down. I really learned this lesson with my fiance's son, my bonus son. Now, he is super dope, is super great at baseball, and he's super crazy great at playing Fortnite. And I learned that his winning attitude, which is connected to a bit of creativity, is really what taught me to be more creative and finding ways to be successful at trading. And when we really think about it, winners that are consistently, successful, whether it's your Kobe Bryant's, your Cristiano Ronaldo's, your whoever, the top tier people, they find ways to creatively up themselves and up their skill set. That's how I was able to find that bullish engulfing on the 30-minute chart that occurs above the previous day high, at 80% success rate, because you have to tap into a certain level of creativity to find the winners for you. And then I have one more quote. I think I do. I might have just lost it. But let's see. It says traders who are consistently successful are consistent as a natural expression of who they are. They don't have to try to be consistent, they are consistent. So just think about that in terms of building your behaviors and your habits, right? Think about the things that you naturally don't even think about that you do. It's just a part of your personality, they're just a part of who you are. And this is why it's extremely important to find a trading style that works for you. When you find one that works specifically for you, it'll be a lot easier for you to get consistent. So for me, you guys see that I like to trade on the 30-minute time frame, but that may not work for you. You might trade better on the daily time frame or the 1 minute. Find things that are consistently in sync will allow you naturally express yourself. So I hope that all resonates with all of us. Of course, if you got any questions, please let me know. We can check out on the chat. But with that being said, what can I tackle? What can I offer? What can I do to give y'all more value? Francisco says, will we be able to watch the recording, bro? Yes, indeed. You will be able to watch the recording. I'm going to show y'all exactly where I'm going to put it right now. Good question. Let's go over here, open up a new tab. So the recording will be available later today once I save it, download it, make sure it's edited and it's good. It's going to be on the Passive Income University YouTube channel. Give me just one moment to go find it. All right, go to Passive Income University. And so here's the channel on YouTube. This is what it looks like when you see the logo here. I'm going to upload it here publicly and it'll be available for maybe a week to 10 days or something like that. And then it'll be exclusive to members of the PIU community. So by the end of today, it will be uploaded. But any other questions that I could tap in or help or give y'all value with, I'm hoping that you guys were able to pull away some mechanisms, some tools, some things that you can implement. If you need help with your backtesting log or your trading journal or whatever the case may be, don't hesitate to reach out to me because I'm definitely here for y'all. right. For sure, for sure. All right, yo. So y'all take it easy. I'll see y'all on TikTok on the lives or whatnot. Peace.